Hi, hello guys. This is Giovanni. We'll get started in a few minutes. All right, so stand by. Hello guys, hello. Welcome, Peter Nicola Chiatti. I like to test the sound. Can you hear me? Raise your hand if you can hear me, please. Thank you, Peter. Fantastic. Okay, let's get allow me to let's allow a couple of more minutes for those who might be joining us late. Just a couple of minutes, if you don't mind. We're gonna be talking about today the stock markets. We're trading stocks as CFDs. So welcome, Mr. Kujoi. Let's get us here, get ready for today's session. Just one more minute to see if more people will join us. Okay. Just one more minute if you guys don't mind. All righty. So hope you guys having a great afternoon, a great day. Some of the companies have already reported today, like GE. They reported by the bell, their estimate was 0.46 cents. They came out 0.68 cents, so they beat expectations. So we'll see how these things obviously bring volatility into the markets. All right, so let's get started here. All right, so today's webinar is going to be called Risk or Opportunities, Understanding the Impact on Stock Markets. All righty, so let's take a look at the who's your host. I'm Giovanni Betancourt. I am a premium senior account manager with Vantage. I have over 20 years of experience in trading the markets. I have a Series 3 license, and I'm also a CMT candidate. Basically, a CMT candidate means that you gotta take several licenses to become a master in technical analysis. So that's where I'm working towards. So a quick disclaimer about it from us. So the information, context, opinions, which are expressed in the presentation and on the following slides are solely those of the presenter and not necessarily those of Vantage, and are solely used for educational purposes, as they do not constitute investment advice and or consultation on how a client should trade. Vantage does not guarantee the accuracy or reliability of the information provided herein. Alrighty, so the agenda for today, well, we're going to be looking at position. We're going to be looking at position sizing and how to short sell. We're going to be looking at market breadth, the VIX, short-term patterns, and market sentiment. And at the end, we'll have a Q&A session. All right, so let's get with it. Well, before, let me give you more information about Vantage real quick. So about Vantage, who we are. Vantage is a global multi-asset broker that provides clients with a flexible and robust platform for trading CFDs, Forex, cryptocurrencies, commodities, indices, and shares. And we've been around for the last, I will say, almost 10 years. We were founded in 2014. All right. Another thing about us is that what we offer plus 1,000 instruments, 100 plus chart patterns, technical indicators, drawing tools, all of these things. All right. What we stand for, what we want to make ourselves notice for, is our lightning fast execution. Obviously, our support, customer support, 24-hour support, our tools, our global connectivity. As an example, we offer ECNs, electronic communication network accounts. That means that at this moment, if you have an ECN account with us, you will be connected to the servers in the New York Stock Exchange, in the States. And when you are trading the London market, you'll be connected to the London Stock Exchange. And that's what our global connectivity is. And that brings you, that's how we are able to bring you light, fast execution, deep liquidity, and so very, very low lags and slippage. So those things are important. So, and with it, learning about investing, I say, and I think is a lot like learning how to ride a bike. At first, it might look intimidating or complicated. Dangers seem to be everywhere. That's why it's important to learn the basics and in ways you can help minimize risk and protect yourself. Okay, so after a good amount of practice and learning, you can take the training wheels off and really start riding along the way. The roads change. There'll be good days. There'll be bad days, just like very much so in the stock market. But while learning to ride doesn't guarantee you a spot in the Tour de France, riding a bike could get you where you want to go a little faster. So in our case, a road to our goals, to our profits. Now, let's start with the basics and look at one of the most common investments in trading, trading stocks. So a stock represents a partial ownership of a company. And when you purchase a stock, you are buying a piece or a share of a company. So by owning a share, you own a small fraction of the company's assets and have a claim on its future earnings. Okay, so that's one way of investing. All right, so you want to make sure you understand where you are. I'm bringing this up because it's important for you to understand the mechanics of it, but we're not investing, we are trading. Now, in this essence, there are several ways you can make money by investing in stocks. Okay, so the first is through stock appreciation. When a stock you own goes up in value, and if an investor bought the stock at one price and the price went up, the investor could then make money by selling the stock to another investor at the higher price. Now, the second way will be through ways of a dividend. This is a direct payment issued by some stock, and a dividend is a way for a company to give a portion of its earnings to shareholders. So that's what the earnings seasons talks about. So that's where we are right now. Now, another completely different way of doing this will be by trading or speculating CFDs on stocks. Now, CFDs, they were developing in Britain back in 1974 as a way to leverage gold. So CFDs began trading widely since the early 1990s. Now, one of the key advantages of trading CFDs is that it empowers you to place a trade where you can speculate that the market is going to depreciate in value. You see trading covers not only profiting when prices go up, but also when values fall. When you buy to profit from rising prices, it's called going long. Okay, so we have in CFDs, you can obviously come in, and the way that you can profit on falling prices is called going short. So you can go long or short selling in a way. And although many people are worried about it when they first start trading, mastering going short is one of the key ways to making a profit in good or bad markets. Now, trading the short side in practice means that you have opened your CFD trade using a sell order or going short to profit from a share price decline. You can you can also go long, and although opening CFD trade using a sell order might sound odd, is simply the equivalent of closing out your exposure to the market. You might look to sell short if a share is falling or you think that is overvalued. Now, there are also several essential decisions when trading CFDs. Now, first of all, we have to discuss what to buy. Then we need to explore when to buy, and we need to determine how much to buy. And we have to have a plan for when to sell. So let's get to our first decision, what to buy. And so when it comes to what to buy, to deciding what to buy, it's pretty research heavy. It also is where you should spend most of your time in this process. Now, due diligence, okay, can completely protect you from an unexpected market turn, since gains are not guaranteed, but it can make sure you know exactly what you're investing in. So when using the process called fundamental analysis to better understand a company, you look through a company's financial statement, okay? And that financial statement, like balance sheets, to determine if it's a good investment, you think of like looking under the hood, right? So you want to look, take a look at under the hood of that investment to make sense of the of what you're doing. So to make sense of the financials, you can look at several ratios and numbers. This can help you answer basic questions like, is this company growing? And help you compare companies of different sizes. We're only going to look at a few numbers. So keep in mind, this is not a complete list. It's just a sampler of some ratios you can look at to get you started. So the first up, what we're going to be looking at is EPS. All right. So EPS is basically stands for earnings per share, which tells you how much a company is profiting for every share of stock. So for example, if a company reported 1 million in earnings, right, and had 100K shares of stock, its EPS will be $10. So growth in EPS over time can show a company's profitability that is growing, the potential of how much of its growth. So that's one thing you want to first look at, the EPS. Next, you want to take a look at return on equity, or ROE, which may help you help a prospective investor address a simple but potentially important question. If I'm considering investing in this stock now, how has this company performed for previous investors? So the return on equity is net income of the company, right, divided by the shareholder equity will give you the ROE. So again, the return on equity is net of a company divided by the shareholder equity. So shareholder equity is the company's assets minus its debt. So the ROE will be considered the company's return on its assets. Basically, it measures how effective a company is at turning its assets into profits. So let's say that a company has had a net income of $10 million, right? And last year, let's say, for example, and at I think the time, let's say that the company has 50 million in assets and 20 million in debt. You take the 10 million and divide it by assets minus debt, so 30 million, and that will mean this company has an ROE of 33%. Now, here's the key. The higher the ROE, the more effectively the company is able to make profits from its assets, which could mean more growth in the future. So you want to take a first look at the EPS, how is that paying out? Then you want to take a look at the ROE. Look at the ROE, again, will give you a better look of how the company is going to turn into profits. So therefore, you're looking at how strong the company will be. Now, after this, now let's take a look at another one, profit margin. So think of profit margin in a way that indicates to a prospective investor just how good of a job a company is doing at turning sales into profits. Now, can it keep costs low and provide room for stronger earnings? The profit margin measures how much of a company's revenue it keeps as profits. So it typically shown as a percentage. So if a company profited 100K of 1 million in revenue, it will have had a profit margin of 10%. Higher profits often mean more potential for future growth. So those are the three things that you want to have to look at, keep in mind. Understand these analytical metrics and how does an investor find companies with strong EPS, ROE, and profit margins. So one way that you can look for or search or do the research for this type of companies is using the website Finviz. In this website, you can filter, and here's where it comes, what to buy, right? We want to be able to where am I going to buy? So using this finviz.com, it will take you to a screener. So let me just bring that up so we can see that. All right, let me share the screen with you guys. Okay. All right. Do you guys see the screen? Raise your hand if you can see the screen. Can anybody raise their hand if you can see the screen? Okay, thank you, Nicola. All right, so in this about Finviz, you can go here, screener, right? And here in screener, you can select which filters to use, okay? You can use custom, you can use charts, ticker technical, by performance, ownerships, things like that. So here's where you'll be able to find those ways to filter out those stocks. But now, if you don't want to do this, okay, if you don't want to do any of that, what you can do, hold on for example. Oh, on for one sample, please. Okay, now we're back. We should be back onto the presentation. Can you see the FinBiz deal now? Okay, so when we use that external site, we want to use that screener, and it will populate several criteria. So we're just going to be speculating and not buy and hold. We will just choose market capitalization as what it is. Okay, so but what is market capitalization? So basically, market capitalization is a very simple concept. It describes how big the publicly traded company is. Now, we have some companies that are small, some that are large, some that are mid-cap, right? The way that this are identified is we take the current price per share and multiply that, okay, multiply that by the current number of shares that are trading in the public, outstanding, what's called outstanding shares. So we have that. So what we do again, how we want to identify, if we take the current price per share and then we multiply that by the number of shares that are trading in the public, outstanding, right? So depending on that amount, let's say, for example, on this one, the price of share is $100 and it's got 1 million shares outstanding, traded in the public. So that gives a market capitalization of $100 million. And that is a small cap. Then we have mid cap and they have larger cap. So large cap will be Apple being the, hitting that 3 trillion market cap early in this month or last month. So that will be one way for you to look at. So by doing so, you'll be able to start focusing in what the biggest companies are. But we have one particular scenario. We understand that we have indices. We have the S&P, we have the Dow, we have the NASDAQ, and we have the Russell 2000. The Russell 2000 is where all of the small cap companies are. Then you have the NASDAQ that holds all the larger caps. Then you have the S&P, a mixture of both, and they have your Dow. It is divided by different sections, industrial, energy, and whatnot. So you have different ways for you to continue to start filtering out what companies you want to take a look at or buy. So since you want to be trading companies that have high fluctuation, high volatility, such as Facebook, Meta, now Apple, Amazon, Google, which reports today, also with Microsoft after the bell. So, and the numbers for those are going to be, so Microsoft has an estimate of 229 per share, and that they're going to report after the close. And then we have Google, that is going to be a report. It has an estimate of $1.34 per share. So how are we going to having this information, and even though they're going to report after the bell, how can we trade that, or what can we do? But before we move forward, we want to be able to understand one thing. We want to have a better understanding of when do we buy. Since we're going to be trading CFDs, we won't be investing, which is for long-term investors. CFDs trading is short-term. So we want to make sure we want to make use of technical analysis. And this is the uses of charts, where we are looking at historical trends, right, and patterns in price to try to predict future prices. So technicians believe that, trends repeat themselves and are predictable because human behavior is somewhat predictable. So we have to identify the current trend, and that's done using technical analysis. And technical analysis is very simple to to understand, if you will. But before we enter a trade, we need to have our position size calculated, right? And we want to be able to understand that if we have this particular behavior in humans, and that we also see how this behavior and our greed will be in full effect when we are trading. So those will obviously will be against you. So deciding how much money to commit to each trade, since leverage can quickly kill you if you overgear your account. So there's no doubt that all traders want to capture big trades, right? Those that double, that triple, quadruple your trading capital. But the fact is that trades that deliver 5x, 10x, or even 20x can be very, very rare. Now, while they do come along, chances are your trading capital can be wiped out if you put all your money in a single trade, right? So that's why we want to be able to, use different ways of using our risk management scenarios, right? So instead of risking it all or a big majority of your trading capital in a single trade, you'll be better off using effective position size techniques when you're trading strategy, right? So what is position size in trading? Now, the simplest definition of position sizing is setting the correct trade size to buy or sell a certain instrument, or calculating the dollar amount that a trader is going to use to open a new trade. It sounds simple, but it actually will be quite complex. So before entering a trade, you should be aware of how much risk you're taking and how it will impact your trading account. So why is position sizing important for traders? As you can imagine, opening positions with random position sizes or based on gut feeling will eventually end in disaster. So position sizing is about preventing excessive losses. If you have a sound risk management plan and follow it, chances are you will not lose a significant portion of your capital on a single trade. It will also give you a chance to keep your focus on your account as a whole and your open positions, specifically for short-term traders who have to react quickly to new developments. And it can be easy to lose oversight and forget how much risk they are already having run before they open future positions. And this is why it's crucial. So a good trader is a good risk manager, right? However, position sizing is not only about preventing excessive losses, it also gives you the opportunity to maximize your performance. And a risk-averse trader who is only willing to risk a tiny percentage of his capital will have to accept the fact that they will never achieve notable returns. As you can see, position sizing is about finding the right balance, allowing yourself the opportunity to maximize your profits while preventing excessive losses. So how are you going to determine your position size? So let's take a look at a couple of popular position sizing techniques so you can implement in order to boost your trading and utilize position size effectively. Now, best position size techniques will be fixed dollar value. So what do I mean by fixed dollar value? Fixed dollar value can be the simplest way to implement position sizing into your trading strategy. Now, this may work particularly well for those who are new to trading or who have quite a limited amount of capital. All that it requires is to allocate a fixed dollar amount to every trade that you take. So for example, you take a 10,000 trading capital. That's how much you have in your account. You may want to allocate 1,000 for per trade or one micro lot. That means you make 10 trades instead of putting the whole amount in one trade. So this automatically limits the risk you are taking per trade. It will also help preserve your capital in case the first few trades you take turn out to be losers, right? So then you also have what's called fixed percentage risk per trade. So if fixed percentage per trade is the most commonly referred to position sizing technique used by traders, you risk a small percentage of your overall capital on each trade. It is an anti martingale strategy, which is the preferred method for financial instruments like Forex. So depending on the financial instrument you're trading, example, Forex, metals, or oil or indices, most successful traders say a 1 to 2% per trade risk is a good rule of thumb. So in front of us, we have that starting with 10,000 and the remaining capital. As 2%, you'll see that you have more of remaining capital than risking 5, than risking 10, and how many trades that you're able to be doing. So using this particular technique is one of those best ways for you to limit your losses. So using the 10,000 trading capital example, you would only be risking 100 to 200 per trade if you use a fixed percentage risk per trade technique. Now, the great thing about this strategy is it gets you to focus on the percent risk instead of a dollar value. Then you're helping yourself fight against your worst enemy, which is yourself. Psychologically wise, we have that particular scenario where we have our worst enemy ourselves to battle your fear. So this will help you doing so. Now, like I said, when you have your capital increasement from 10 to 20,000, your 1% risk moves from 100 to 200 risk per trade. So likewise, if your capital decreases, you still just risk 1%, but it will be a smaller dollar amount. Hence, it is an anti-martingale strategy. If you don't, you will soon find out that big risks you take in every trade can easily eat up your trading capital. So to illustrate the margin leverage points, look at the positions that we have here in this image. We have that 5%. At 5%, you already risking $4,000 out of that trading capital. So there's a lot of different things that you can start trading. So one thing that we want to be, I want to leave before we move into looking at trading more capital, some of the stocks, it will be short selling stocks. So if you are a short seller, okay, basically what you're going to be looking at is you're going to be borrowing, let's say, 10 shares of XYZ shares at the current price of 50 pounds. That's the first thing you do. So you have to have the shares themselves. You got to be an investor. You got to be holding the shares. Second thing that you will do, then you will sell those 10 shares immediately for 500 pounds, right? Then the third part would be XYZ stock did fall in value down to 30 pounds per share, right? So at this point, you buy back the shares at the new price of 300 pounds, and then you return the 10 shares and pocket the 200 pounds difference. This is pretty simple. This is the way how you will do it if you will be short selling stocks. If just write out doing the stock, the investment. Now, when it comes to CFDs, it's very simple. You open a short position on your share, on the shares you own. Let's say, for example, you actually own Apple. So you short the CFD trade, and we can trade into profits, helping you offset the loss of the share value. So if you're holding Apple, you bought it at, let's say, for example, you bought it at 190. Now it's trading almost to 210 or where the price is at. So the market, it reports on Thursday, but let's say, for example, for whatever reason, it missed out on expectations, all right? And so therefore, you will come in and just simply short the market or short Apple by entering with a sell order. So the market, you enter at 210, let's say, for example, and the market falls back where you bought the stock, the actual stock, at 190. So that's the $20 difference. Well, that $20 difference that you have lost on the value of the share itself, you have gained it by trading the CFD on that position. Okay, so we have differences between markets. We have bull versus bear market, some of the pointers that we want to look at, a bull market will be obviously prices are rising, high investor confidence, strong economic conditions. And the opposite of that will be the bear markets, will be prices are going down, low investor confidence, and weak economy. When it comes to this, both of them, we want to take a look at factors that cause the market to go up and down. All right, so the very first one will be supply and demand. We want to, obviously, that's the key element in that. But obviously, we want to have market indicators. Where are we in here? Confidence index, CPI, for example, right? So when we have wars or the conflicts, right now we have a war, in Ukraine. Then concerns over inflation or deflation. Again, we come back to what Mr. Powell will do this week. A lot of people are talking about, yes, he's going to hike, another hike rate, 25 basis points. But what about if he doesn't? Then that's one thing that could happen. But he's saying that he will do it. So then we have government fiscal and monetary policy, which obviously comes down to the Fed. Now then we have technological changes. Right now we have a technological change in AI. AI is having a boom in the markets right now. Then we have natural disasters, extreme weather events. All right, so for companies, for stocks, this might not really affect them as much as a commodity would. So let's say, for example, right now we have is not a natural disaster, extreme weather, but we have extreme weather, actually very hot weather now we're breaking records. So if you were trading, let's say, for example, corn or wheat, which is, right now the Russians are not exporting wheat. So that right there happens to be another part where you can take a look and see that fluctuation and that volatility in that market. So then we have corporate or government performance data, which is where we are today, this earnings seasons. Then we have regulation or deregulation. And in regulation, the best news that is coming out is how the cryptos are going to be regulated. So, BTC, Bitcoin being the only asset that is tradable or that is considered a commodity, is going to be regulated. So that's one of the things. So then we have a level of trust in the financial sector. So that is a personal issue. Then we have the level of trust in the legal system. So yeah, legal system, can we see the SEC coming in and doing the bidding, stopping the merger between Microsoft and Activision. So that right there, could that hamper Microsoft performance in today's earnings call? So those are the things that you want to also be listening to. Where is that standing? How will they talk about that? How will Microsoft having AI in their Office apps for businesses? How will that increment? Will that increment their EPS or the ROE? So those things are going to be essential for us to come in today. So let's say, for example, that we know that they're going to let's take a look at the markets. Let me just share with you let me share you my screen. Hold on for a second. What has happened here? Allow me 1 second. I'm trying to change the sharing. Okay. Let me come over here and do. Okay. So many screens. I gotta find them. All right. Can you see the charts? Can somebody let me know, please, if you can see the charts? Thank you, Nicola. All right, great. So now let's take a look at what Microsoft could do. All right, so this is Microsoft, right? And Microsoft here, we are in a daily chart. All right. This is a daily chart for Microsoft. Now, if we were to be investing, right, in Microsoft, and we happen to buy it at 350, that's where we buy, this is investing. So we're going to be holding the stock, right, for a long time. But now we want to be just speculating on his value. So what can we take a look at? First thing that jumps into my awareness, into my view, is that it opened with a small gap, with a gap up. Okay, so this candle closed at 345, and this one opened at 346.73. So a dollar and change difference. The gap has been closed. Okay, but when you see this type of scenarios, when the market opens with a gap up or a gap down, after it's closed and it continues with the moment, with the direction of the gap, which is up. If we had been earlier today, when it first opened, we had seen that, then we could take the assessment of that the market is looking to go higher. So from the momentum, or from the rhetoric, or from all of the market buzz that is going around Microsoft and AI, and because obviously Microsoft is saying that they're going to be charging $30 for the uses of their apps, Office apps on businesses, $30 per month, right? Every month. So per user. So that's a big bump. That should be a big bump in revenue. So therefore, we're seeing that momentum being factored into the stock, even though their earnings call is after the market closes. We are seeing already how this is being factored in. Now, there's also another saying that goes like this, buy the rumor, sell the fact, right? So in this scenario is what we could be appreciating that's happening. The people are buying the rumor that since Microsoft is going to be charging $30 to the business consumer per user monthly, on a monthly basis, then that is being factored in. So if their dividend is estimated to be 2.29 cents, and they beat that expectation, let's say, they say it comes out at 2.80 or $3. So talk about round numbers. So therefore, we'll see after the market, most likely a continuation of this movement to the upside. But now, if they miss the call, if they miss their estimate, and they came out at $1.50, for example, then you most likely will see this drop. Okay, so that's the difference when you trade CFDs, because you're able to jump into that market action. If you were holding the stock, you would have to short sell the stock, right? And you have to go through the whole process that I showed you before. But short selling or going short in CFD is very simple. Just come in, right? Sell, and I'm just gonna do this for exercise wise, just for that. So you have sell, market, just click sell, and you're in, right? Order open, place. That's simple. It's that simple. That's how easy it is to come in and do a short sell or enter a short position in this. I'm gonna close this because I think that the company actually is going to continue to move higher. Now let's take a look at another company that is also obviously today, that they're reporting today, and they're also reporting after the market closes, which is Visa. Their estimate is $2.12. So look at this, another gap up. When it opened, this candle closed at 121.84, and this one opened at 122.13, 121.35, 122.13. All right, so 60 cents difference. But however, the gap has been closed, and they came down towards it, they closed it, and it found some footings, it found some buyers around the 120, 150 area, and then it rallied back up, and it's rallying up. It came up to 123 and retracing. Perhaps this could be the 123 marker, could be a position. Now let's take a look into this stock deeper. Let's go into 5 minutes to see what the price action is like. Okay, so looking at this market, this price action from here, if we happen to use our Fibonacci retracement tool, all right, and we use this low and we use this high, I will assume that this movement so far has been somewhat about the 38%, and it hasn't really been the 0.38%. So 0.38% for me, it tells me that if the retracement, the pullback, the correction the market makes, or an asset makes after having such a nice strong move to the upside, that 0.38%, if it comes down towards it and it rebounds from it, that the previous movement will continue. Is a higher chance. Now, we obviously, if we use the Fibonacci, we want to use the golden ratio, which is 0.618. All right, saying that the market, as the market corrects itself, it should come down all the way down to 0.618 or towards that area to find new buyers, right? So the correction could be managed, or it could be taken that if there's going to be a deep pullback, a deep correction, the 0.618 will be that level. Now, since we are in this time frame, we are we're pulling, we have a pullback. The 0.38% will be my first level where I will come in. I will be monitoring to see if the market actually retraces from here or rebounds from here, which is at around the 123 area, which makes it a psychological number, a psychological value. So that's also a psychological support. So therefore, I'm having 0.38% as my Fibonacci number that will tell me that this movement, or this run to the upside, will continue if it comes down towards it. Now, at that moment, we've seen that the price action is actually just playing with 1320. Will it stay? Will it hold? Well, we are right now, we are about to enter. Well, actually, we are in lunch in New York, so probably the volume is not that high, but we want to be able to take advantage of if the company I'm sorry, this is Google actually. So if the company will actually come in and report itself in Google, their estimate is $1.34 in EPS, earnings per share. Then if it beats that expectation of 134, being Google and being obviously one of the main runners in AI, will this have more room to grow, another leg up? It could be, and we want to be able to use that momentum. If this is going to be an extension, we want to be able to use Fibonacci extension, the trend Fibonacci extension tool. So from where do we do this? All right. So the closer that we get to it, it could be one way, but we want to capture the momentum. So we look at this low. From here, we see that the market has been rallying to the upside. It made a quick correction, a pullback. And so from this pullback, we want to start measuring if this movement to the upside is going to continue, or will it come down all the way back down to where it started, is rebalancing. So we want to measure here, this low, and measure that high, right? And then we just extend it to where the market, this low, where the market is actually. And we want to see if the market will continue with its momentum to the upside. So therefore, we want to be able to use also the Fibonacci levels. So 0.38%, as it reaches it will be one resistance. Then 0.618% will be another target. Those are the targets. So the Fibonacci numbers are our targets to see if this expansion or this movement to the upside will continue. Okay, so right now we actually are in this time frame. We are creating a basically same highs and same lows in the candle, in the body. So that's creating a range. Now it's looking to break out of this range to the downside, right? So if we use this tool as our support, we look to the left and see that this open, or this this high, the moment of this candle, can be used as a support because it was previously a resistance. So we want to be used it now. Now that it's a support, we'll define a support and just make the price action move higher or trend higher. That could be one explanation for us to see if the market right now is factoring in that Google will beat expectations. So as we trade here in 5 minutes, we have been just really ranging because we have been within the body of the previous two sessions, of two candles. So right now we are seeing that there is a battle inside between buyers and sellers for it to maintain the price so far at the level of 123.15, around that level, because this is where this candle happened to open, and it created that resistance initially for it because it traded lower, but now it has turned into a support. So here again, we're just waiting for market direction, macro action to show us where is it going to go. Is it going to continue to drop into the body of this candle, or will the volume or this volume node that was created here before, can it be strong enough to hold on to all those sellers and more buyers coming in to take the market higher? So right now it's just also because of the time date, low volume, but that's one way to look at it. Let's take a look. Let's look for Visa. Here's Visa. Okay, so Visa, there it is $2.12, their estimates, and they also are going to report after the bell. So looking at Visa, what can we take a look at? What can we see? It didn't, in a daily chart, it didn't open with a gap up as it has with the previous two, Google and Microsoft. So in this scenario, the Visa, which is, I use it because it reports today after the bell, and it's also something that we all know, we all of us use it. So that's one of the things that you want to be able to trade companies that you understand, that you know, that you like, okay? Because that will help you come in and be on the right side of the trade. So the RSI is further from being overbought. So that's one thing that it could help us come in, that say, okay, so if the consumer is healthy, and even though interest rates are higher than usual, our consumers are still using Visa, their credit card. So if they come out and they beat expectation, it's telling us that we do have a good consumer, that they're still strong. So therefore, we most likely will see an appreciation on the price of the share. But if they miss expectations, if they came in and reported something below $2, then most likely what we'll see is obviously a depreciation on the stock, and therefore we can anticipate, or we can take a look at the history of the stock, of what happened. And in this particular scenario right here gives me a note. If we have dojis, within gaps, so therefore telling us that around this particular area where we actually traded yesterday off of, is an area of interest where we could probably see that if they don't meet or beat expectation, that the depreciation of the stock value will come down, and our targeted our points where we could probably see some support would be around the 236. So we could come in and short the stock. Now, how high can we anticipate the stock to move if they do beat expectations? Well, you always want to take a look at the left and see the highest point, which it would be this one, made on July 17th, 245. So if you are risky and you want to make a place a trade in this particular stock, then you could use that 1 or 2% of your capital and buy the stock now and hold the stock overnight. Remember, right now we have a special going on that if you trade shares on CFDs on shares, there will be no swap fees charged to you. So there are no swap fees, overnight fees. So you could trade the stock, hold on to it, and see what will happen out of it, out of the call, the earnings call today. That's one. Let's take a look at one that actually reported before the bell, and that would be GE, General Electric. Okay, so General Electric, they had an estimate of 46 cents. That was their estimate. They beat that expectation. Not by much, by 12 cents, by 22 cents. They came out at 0.68 cents. That was their EPS, but it was good. It was they beat expectations, and so therefore, since it was before the bell, right, you could probably most likely understand that if they beat expectations, that the stock will appreciate, and therefore we see this big gap up. Okay, this big gap up. Now we are in the overbought territory in the RSI, so therefore that has been already is a momentum is being run, but there's a lot of more things behind this company, GE, General Electric. So there was an article. There's actually something going on with planes and engine planes, to be more precise. They're gonna start reviewing or doing a deeper exploration into the metals that is being used to build the engines. So most likely we're gonna be seeing. I started hearing a lot more about this and how will that impact the airline industry. So will they have to ground planes again? But right now they won't do that because obviously it's summertime. So that's the demand right there. So could you look at some companies that are dealing in the airline industry? Delta is one of those companies that you could probably take a look at. But talking about GE, we see that gap up. We see that by them beating the expectations, the stock appreciated gratefully. But will that be the end of it? 118 almost on the stock. I would assume that for today, yes. Correct. For today, we could probably see just profit taking happening right now. Will this gap be closed? That's another scenario that could also happen. Market just makes a pullback, a retracement, a correction, and comes back somewhere halfway of this gap, or a quarter way, or all the way. We don't know. But this area, this zone right here, which makes almost equally higher highs and equally lower lows, almost is called, I call this ranging or lateral, is sort of interest, a volume node. So this actually has created a good level of support for the stock. So if the stock does happen to to pull back, then we will most likely 112 will be our initial place where we find the support. But for right now, I would assume that the stock will continue to do some pullback. 116 internally will be that level where we are to see if we find some support, and that will be one of the places where you could probably find an entry point to go long on the stock. But that's just me. Another one that we have that we're looking at, Meta, that reports after the bell, after the close. Their EPS estimate is $2.60. So talking about the metaverse and how this company, where would it find revenue? So we understand that the metaverse, Mark Zuckerberg really did a job on Musk, in which you see memes about them two fighting over their new platforms. So how will Meta be able to capitalize? I know how monetize that and be able to bring earnings into the company and to make our ROE even better. So right now, if you look at this particular stock, you will see that it actually opened with a small gap down. So this candle, it closed at 291.55, and this one opened at 295.74. It closed at 291.55. I mean, this one opened, sorry. This one it opened at 296.56 because it's a red candle. And this one opened at 295 or at 0.74. 296.56 and 295.74. But it's a gap down. It was closed, as you see that, and it's trading lower now. So will the momentum, will the direction of the gap tell us that they're not going to meet expectation? 2.62, that's the EPS estimate. That's what they should report today after the close. Will they do that or will they not do that? So here's another scenario for you to understand it. So if the stock opened with a gap down, will that be an indication that, the information has been leaked and the company will not meet that expectation? So therefore, that has been factored in by this movement. That's one way to look at it. Another way to look at it would be, okay, it opened with a gap down, but it quickly fluctuated above it, coming closer to $300, but it quickly retraced and back down below yesterday's open. So with yesterday's open, I beg your pardon, yeah, open. So I beg your pardon, this candle opened at 296, right? And it closed at 291. And this one opened at 295. And I beg your pardon, at the end, I got my wires crossed. So this actually opened with a gap up, strong gap up. It was close, kind of close halfway. So this candle, it closed at 291.55, and this one opened at 295. So it's a strong gap up. All right. So now I'm gonna have to excuse myself and ask you to erase what I said before. So we're taking a look at this. A gap up, a strong gap up would have meet expectation of 2.62 cents. That's the key right here. So perhaps it will be because it's a strong gap up. But if you look at it, with such a strong gap up, the market hasn't really moved higher like it did with Microsoft and Google, that it had a smaller gap up, but the market was higher. So could this just be profit taking? Could this just be a better positioning for ourselves? Because as when the company reports, will it just fluctuate up past $300, which is a psychological resistance level? So that's one way that we could probably look at it. Okay, so again, with this strong gap up that the stock opened, will that translate into further movement to the upside as the numbers come in? So that could be that scenario, or it could be also, like I said, it could be also that it came up with a strong gap up, but the number is not going to be as expected, so it's trading lower. So that could be your scenario. All righty. So let me do some Q&A. Does anybody have any questions? All right. All right. Well, thank you for participating in today's webinar, and I will see you next time. Thank you for watching.